Morning all, this is the 0DTE morning market analysis and it is January 10th, Monday, January 10th, post Super Bowl day. I watched the Super Bowl. It was interrupted by analysis and it is January 10th. Oh boy. Monday, January 10th, post Super Bowl day. I watched the Super Bowl. It was, sorry about that. It was interrupted with a buffering issue that Fox had, and so we didn't get to see the halftime show. Not sure if it was worth seeing or not, but in any event, it was an exciting Super Bowl. I am a Patriots fan, or was a Patriots fan, and so it was a good outcome for me. Anyways, enough of that. We're here to talk about 0DTE and how we're going to situate our trades. The 0DTE strategy that we practice is a asymmetric, out-of-the-money butterfly, and we're looking to put on very small risk for large potential return. And every morning we look at three primary factors. The first being the VIX, the second being the market direction, and the third being the market structure. And from that, we know exactly what we are going to do when that time comes. All right. So the premise is that we're options traders. We're looking to capture both premium and also be in the right direction and try to capture price movement as well. So we're directional traders as well. We put an out-of-the-money butterfly either above or below the market, depending on what we determine is the market direction for that day. And it seems that that's a very difficult thing to determine, at least over the last several weeks, because the market has just been going sideways, nowhere. The reason why we look at the VIX is because the VIX will properly price options, and it will determine whether or not premium has accelerated its decay or has delayed its decay. And what that will mean is if it's delayed its decay, that means that we have elevated volatility and there's more premium for us to grab. If it's accelerated decay, that means that it's low volatility, and that means there will be less premium to grab. And we adjust to that because our main job is to be risk adjusted so that we can maximize our return on the capital that we put to work. Everything is about preserving your capital. So enough talking. Let's get on to it. Let's talk about the three things that we're here to do. And the first is looking at the VIX. And this is my enormously annotated VIX chart, but this is what we use as our guide to look at what trade that we're going to put on. We're always looking at an out-of-the-money butterfly for sure, but there are also edge cases that happen when we have extremes in volatility. Right now, the VIX is sitting at 16.27. As you can see, I break it up into what I call three volatility regimes: Zombieland, Goldilocks, and Chaos. We are currently in Zombieland. And, I make those names just to be illustrative of how it really feels like you're running through mud, being chased by zombies. And we've been there for a long, long time, occasionally getting up into the Goldilocks regime, which is a much more satisfying place to be from an options trader's point of view. And you can see for a long time we were up in that area, but for the last, since mid-2023, we've been stuck there with an occasional. Now that we have this new administration, I anticipate that we're going to be seeing Goldilocks zone quite a bit more, which it could be a good or a bad thing depending on how you're situated. But from an options trader's point of view, it's a really good thing. All right, and from that VIX level, we have a range of widths that we're looking at. And so over here on the left-hand side, you can see that range right there. And so at this level, we're looking at 15 to 25 wide. Notice it's a range. And what we do is we take a look at this sort of fine-tuning mechanism up here, which is up here, where we look at what we call the big-ass fly, which is nothing more than an at-the-money butterfly, looked at 50 wide, super wide, looked at pre-market. And with the reason why we do a pre-market is that sometimes it can turn into a trade if we have interesting economic reports that might come out pre-market. It's usually around 8:30 that could cause a rise in volatility and maybe a volatility crush event. And then we'll look at taking the big ass fly if the conditions are correct. That's one of our edge case trades, by the way. And if it is below 25, then we look to take that trade. Now, I would expect as we go further on into this week, we have a lot of very, very impactful economic reports and events that will certainly boost up that morning volatility and put us into a situation where the big ass fly makes a lot of sense. For instance, we have inflation, we have the CPI and PPI coming out, and we have Jerome Powell set to testify 2 times this week. 2 times. So all of that should have a lot of effect on the market. So the next thing that we're going to do is take a look at the big ass fly. And here it is. As you can see, it's a 50 wide fly put on with the E-mini S&P futures. It is currently just under 25, so it is a viable trade. The reason why we say it's a viable trade is that when the debit is this low, it gets just in range where we consider the amount of potential profit that we can make versus the risk that we're taking on, and that risk includes the gamma risk or the sensitivity to price. We feel that the profit curve will be flat enough that it gives us a good opportunity. And because there are no economic reports this morning, we're not necessarily looking for an event where we can see volatility crush. So this is a little bit tricky situation. Mondays, there usually isn't any economic reports. So if you're going to be putting this fly on, we may not see that volatility crush event as we normally see after a report is released at 8:30. And oftentimes we can take that trade off right in before the market even opens with a couple $100 of profit. But got to be careful on mornings like this. Yes, volatility is elevated a bit. Can we see kind of a shadow type of volatility crush before the market opens? I don't know. But typically when the market opens, volatility is at its peak. And so it might make sense to wait until the market's open if you're going to put this trade on, and only if we're at 25 or lower on the debit. All right, you got that? All right, good. So let's go back to our chart. And we can see that 25 wide is right here. So we're right in the middle of our width. So it looks like we're going with a 20 wide, either an E-mini S&P futures butterfly or an SPX. If you're looking to put on an NDX or an NQ, which are for the NASDAQ, we would typically go 3 times that, 3 to 4 times that. So in this case, I would say that, a 75 to 100 wide fly is more in line with what we would want to do on either the NQ, E-mini NQ, or the NDX. So it's also a very a viable way to trade the out-of-the-money butterfly. It's got lower liquidity, and it's far more volatile. You usually get much better pricing. However, you have to watch out for that liquidity bit, but sometimes you can get a great price and fantastic action. So consider the NDX or the NQ if you've got that in your head, that you think that there's going to be a little bit more extra volatility, and I can make some hay that day. All right, so now we've got width out of the way. The next thing to do is take a look at directional bias. And is the directional bias bullish? This is one of those days where it's really, and actually over the last, I would say since the beginning of the year, it's been really difficult to tell which way we're going. I mean, we had one little stretch where we had a a little bit of a run here where it was a lot easier, but we've been basically going sideways, and now we're sitting here right at the edge of the moving average that I usually am keyed on, and it's even undecided. Well, let's take away this volume profile. You can see it's just vacillating back and forth there. So I don't know. I think it's a coin flip, but looking at this bar right now, I look at that pattern, candlestick pattern. That's a piercing candlestick, and I think according to Bulkowski, that might be one of his top 10 as far as efficacy. And so I'm going to say the directional bias is still bullish for today. So that's what we're going to do. We're going to put on an out-of-the-money call fly. It's going to be about 20 wide. And then the third and final step is to look at market structure. Now, this is super interesting. Now, I haven't done a market structure analysis for a couple of weeks. And I thought I would clear up everything, clear all my annotations and everything, and then redo it and just go through it very quickly. What we're looking for ultimately is a move. If we're going bullish and we think the move's going to move up, you know that the market never moves in a straight line. So what we're looking for are pullbacks into a structural level. How do we find structural levels? Well, we look at the market profile. Structural levels are at the edges of nodes and these deep crevices inside of these volume wells. So most people will call these nodes high value nodes or HVNs, and then the volume wells, they'll call them low value nodes or LVNs. I call them volume wells. But where you're going to find support and resistance is on the demarcation between where high volume has transitioned to low volume. That line right there is where support and resistance happen. So as an example, if I were to look at this edge right there, you would find, let me make it a different color so you can see it, right there. You would find that if I were to zoom in on a daily chart, you're going to find that the market finds that as support and resistance. And similarly for the bottom of that node, right about there. And then also for these deep crevices. You have to wonder, why is the market avoiding those specific levels consistently every time it goes past them? Those really deep crevices, they also provide a fantastic way to identify where support and resistance are. Now, it gets a little wonky in this area here, down here. It's definitely kind of frothy, but it's still been an excellent place for us to place our market structure and our entry events. So I'm going to do that right around. So here's price right here at 6103. It's actually up this morning. And you could even look at these little deep crevices inside a volume node right there. What I'll do is I'll typically make those a different color, but we'll get to that. And let's see, right there. And this is a little difficult because it's, there we go, right there. And let's see, any more? We're within range here. We're going to probably move up through this node today. And I would say that that would be our next one. Now, when I'm zoomed in, I can't see where the nodes are. So what I would typically do is, because when you reposition to a 5-minute chart, this is a 4-hour chart so that I can see as much of the volume profile as possible. When you reposition and go to a 5-minute chart, I can no longer see that volume profile because TradingView will only show me the whatever's in the chart and then calculate the volume profile for that. So if I zoom in, then I'm missing all of that historic volume. So that's why we actually mark it up, so that when we zoom in, we no longer need the volume profile. We have the structure already identified. But what I do for these nodes is I want to see whether I'm at the top or the bottom of a node. All right. And so the way I'll do that is, first of all, I'll make them thicker like this. And secondly, I'll color them. And I put the bottom of the node, I always make it green, because if you bounce off of it and go up, it's bullish, right? And I make the top part red, as if it's bearish, just to distinguish, really. And then we'll do the same thing for over here. Right there, we'll make that 4x and red. And then the bottom of that node, if I can select it, 4x and green. All right, so now when I'm zoomed in, I can see exactly where those levels are. Now, do I do these here as well, these tiny little child nodes? Probably not. Maybe put one more right here. Whoop. And make sure that that is a proper color so I don't get confused. And I'm going to put one more right there. All right. Okay. Can you go wild on this? Yes. Look, if you can draw in a coloring book, you can do this analysis. But I'm telling you that each one of these features here is significant. So once I've got it all mapped out like this, I can go to a 5-minute chart where I can see an individual day. All right. And now that I've drawn this, you can see how the market has literally just danced around those lines that I've created. So it's very evident that these structural levels are surely impactful and real, and they work in real time. So by doing this analysis, you're actually able to identify structural levels, support and resistance ahead of the game in real time. The market follows market structure, and it has memory. And you can go back literally not just a few months like I have, you can go back years, even decades, and you'll find that profiles and structural levels persist over a long, long, long time. And from a professional trader's point of view, this is really what we're looking for. Most professional traders trade on two different factors, and that is volatility and levels. They all know the levels, and then they just adjust for the volatility. All right, so there we go. Now what we're looking for is a trade in the early morning. Well, in the morning session, not necessarily the early morning, but the morning session, which is between 9:30 and 12:30. So we're looking for an event that happens in between that time. So remember, I said that markets never go in one direction. So in this case, we're choosing a bullish direction. So we're expecting markets to do some, they never go straight line, right? They always do something like this, right? So everyone knows that, well, maybe not everyone, but you should know that if you're trading with the trend and it's a bullish trend, the best place to enter is on the pullbacks. And that will be on these pullbacks like here and here. All right, so where do they pull back to? Well, wouldn't you know, there's a very, very high likelihood that that pullback is going to be on one of those structural levels. So we're looking for maybe something like this. Bam. And then when that happens, we take that trade and we put on an out-of-the-money butterfly, maybe up here somewhere. Of course, our out-of-the-money butterflies have, we already know exactly what we're going to do with it. It's going to be a call fly, it's going to be 20 wide, and it's also going to have asymmetry. In other words, we typically follow the 10% debit rule. So we make sure that the debit is no more than 10% of the width of the fly, and that will give us about a 1 to 9, 1 to 10 risk to reward ratio. Again, asymmetry. So there's our entire setup for the day. Now, of course, it could also come down to here or to here. Those are all possibilities. We have ways of determining whether or not that it's reached that limit. Those are things that I'll maybe talk about in future episodes. But there we go. We have everything that we need. Back to the big head. All right. So we know how wide we're going based on the VIX. We are 20 wide. We also know that we're kind of close or right on the edge of a big ass fly, and we may or may not take that. I would recommend waiting until after the market opens because of the lack of economic reports this morning to capture a volatility crush event. There will be some volatility crush or a decrease in implied volatility as the market progresses into the morning. So if you can get a good price on the fly and then try to take advantage of that event, the shorter time we can take be in the trade and also take advantage of decreasing volatility, which will increase the value of our fly because of that increased premium decay, the better, right? So we have, and we have direction. We chose up, mostly because it was kind of a coin flip, but I think the piercing candle probably gave us the edge on that. And we know where our structural levels are. We've all mapped them out. We're waiting for one of those entry events in the morning session. Everything right there. So there you go. That's today's episode. I want to thank you very much for being here. Make sure you have your coffee and you're ready to go. Clear-eyed, bushy-tailed. Thank you very much. We do this every single morning at 7:45. See you next time. Coach Ernie